Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Today, it's all about Nvidia. After the New York close, the company reported data center revenue for the latest quarter slightly below expectations. And Nvidia said there were no sales of the H20 chip to customers in China. On top of that, Nvidia is now removing China data center revenue from forward projections. So the outlook for the current quarter, $54 billion, plus or minus 2%. But some analysts found that guidance underwhelming. Here is Bloomberg analyst Mandeep Singh.
I mean, just the guide, the 3Q expectations were 54 to 55 billion. And to my mind, this print is not something to be excited about.
Mandeep Singh there from Bloomberg Intelligence. Now, you'll remember recently the Trump administration did ease restrictions on exports of some AI chips for the Chinese market, that being the H20 principally. And remember, the administration also recently agreed to a 15% revenue cut from sales in the Chinese market. Well, today, in a filing, Nvidia says that could be the subject to litigation. In a moment or two, we'll have reaction from the Asia-Pacific perspective, but we begin here in the States. With me now is David Waddell. He is the CEO, also the Chief Investment Strategist at Waddell Associates. David, thank you for making time to chat with me. Can we just pick up on the Nvidia story? I'd like your reaction.
So they beat on the top and the bottom lines, and their gross margins at 73.5 were higher than expected. But if you read some of the subtext, there are reasons to, I guess, take Nvidia off boil. So overall, it's a superlative quarter. They're putting up amazing numbers. But the unfortunate thing is that investment returns are really just the difference between reality and expectations. And when expectations get too high, it's sometimes hard for reality to meet them, even when reality is as superlative as what we saw in this report.
Where does it leave you in understanding where we are right now in this artificial intelligence cycle?
Well, I mean, the analog to the late 90s, I think, is very correct. So if we go back to the speculative fervor between, call it 97 and 99, we're probably somewhere in that zone. Doesn't mean it's over, but it does mean it's pretty stretched. So if you look at the S&P, we're trading at 22.5 times earnings, and in 1999 we got up to early 2000 we got up to 25. So we're pretty close to where we've seen previous tops. We saw a top around this level also in 2021. I'm not really calling for any outright decline here, but I think investors just have to be mindful of the fact that this trade has gone on for quite a while, and Nvidia is at 4.4 trillion, and the AI build out will be great. But at some point, there is going to be a slowdown in CapEx somewhere. Somebody will, dial back their forecast, and then all of these things start to look a little bit vulnerable. So we've seen, spurts of downside volatility from the stock. I'm not predicting that, but I think if you're buying it, you just have to be eyes wide open to the fact that, it could be a bumpier ride here as growth rates decline.
So there's also the interest rate component to all of this. In the bond market today, those shorter dated treasuries continue to outperform. We had the 2-year in New York trading down about 7 basis points to 360. The market's convinced we're going to get a rate cut next month. Whether it's 25, some are saying it could be as much as 50. Weigh in on that for me. How do you think Fed policy is going to unfold in the near term here?
Well, if they don't cut rates, Trump's going to fire everybody. I mean, there's a lot of political pressure, unprecedented amount of political pressure from the White House here. It's clear that the desire is for lower rates. What's amazing about this is that you are seeing the yield curve steepen, but you're not really seeing longer term rates. You talked about the 10-year really run away here. I mean, the Fed is restrictive, right? So the real Fed funds rate's about 1.6. It needs to be about 0.6. Or at least that's kind of long-term average. So Trump's wrong about a 3% cut, but the market's right about a 1% cut over the next 12 months. And that does have implications for the market, specifically for small caps, where Reality has been much higher probably than expectations, but could go even higher, and that could lead to a rally there. So I think the story of the first half was AI. The story of the second half is the rate cut. The benefit in the first half obviously went to Nvidia and friends. The benefit in the second half and rolling into 2026, I think, goes into small caps, and the market's figured that out.
So if right now the focus is on weakness in the labor market as a justification for easing, I'm wondering if there's the risk, and maybe that's what we're seeing a little bit of in the long end, that inflation could remain stubborn and sticky. Is that a possibility?
I think that not only is a possibility, it's a probability. If you look out over the next 2 years or so, the amount of stimulus we've got in the pipeline is significant, right? It's fiscal stimulus. Now we're talking about monetary stimulus. We've got dollar depreciation stimulus. We've got all sorts of stimulus in the pipeline that far outweighs the tariff drag. And all of that pulls through and peaks really mid-year next year. So it's kind of unprecedented to be cutting rates in an environment like this. I understand the desire for it, but I imagine a few years hence that turns out to be a mistake. The speculative fervor will lead to increasing debt, specifically among the corporations and the consumer sector. And then, the Fed will have to raise rates again, and that'll create exposure, and that's how you get to the end of a cycle. Because even though the federal government has bulked up their debt loads, consumers and financials and corporations really haven't yet in this cycle. And that's the last stage of the cycle that needs to occur. And my guess is you take rates down, those debt loads go up amidst, good economic growth, good earnings growth, and that's what creates sort of the kindling for the fire to come.
One of the things that the market had been looking for was the M&A activity in the early part of the Trump administration. That seemed to take a back seat initially because of the tariff story. But I was looking at some Bloomberg data earlier. In the month of August alone, we've got deals worth a total of nearly $300 billion combined. Now, deal making, as you well know, typically slows in the summer months. What does this burst of M&A activity tell you about the economy overall?
Well, it also is in conjunction with IPOs up 30% year over year, with SPAC issuance up 300%, with buybacks up $1 trillion. I mean, the music is playing and everybody's dancing, right? The windows are open. There shouldn't be regulatory restraint. Lower rates are also going to stoke M&A activity. I mean, even anecdotally among our clients, I'm seeing a lot of LOIs on businesses. I'm seeing financing open up again. I think there's just a lot of momentum and velocity twirling underneath in this economy. And I think people underestimate it because they get distracted by like Trump versus Cook. But in reality, I think on the ground level, things are better than people think.
So where are you finding opportunity these days?
I mean, we've moved steadily from the top right corner of the style box down to the bottom left corner. That's not an absolute move, but I think investors should be doing that. When we get into this late stage of the rally, to me, the way you insulate yourself a little bit is get your PE down relative to the market. Trump's policies really support financials. They really support industrials. They really support materials. They really support smaller cap stocks. And you're starting to see that rotation occur. And my guess is with the Nvidia news today, it just sort of reinforces that. Like I said, I don't think the AI trade is over, but I think there are opportunities elsewhere, and investors would be better served migrating towards those.
What about the industrial policy that we have had come out of the administration? I'm thinking about the U.S. Steel deal, also the Intel deal recently. Is there something that you want to be alert to for potential opportunity?
Well, I don't even know if that's constitutional. Like I said in our preamble, is Trump going to buy Nvidia because it sold off 3%? I mean, we're off the map on some of this, and it is industrial policy. But if Trump is going to flex his industrial policy agenda, then that's going to benefit the hard asset industrial companies. It benefits Boeing, which you've seen. So if you know he's going to do that, you can take issue with the methodology, but you know what his intentions are, and the stocks that he's pointed towards have performed. So whether it's right or wrong, I don't know, but you can profit from it.
David, we'll leave it there. Great stuff. Thank you so very much. David Waddell is the CEO, also the Chief Investment Strategist at Waddell Associates, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Nvidia issued a lackluster forecast after the New York close on Wednesday, and this excluded data center revenue from China. This is a market where Nvidia has struggled. We have the U.S. export restrictions as well as pressure from the Chinese government. Earlier this month, Bloomberg reported that Beijing had urged local companies to avoid using Nvidia's H20 processors, particularly for government-related purposes. Even so, Nvidia CEO Jensen Huang struck an optimistic tone vis-a-vis the Chinese market on the earnings call.
So I think the opportunity for us to bring Blackwell to the China market is a real possibility. And so we just have to keep advocating the sensibility of and the importance of American tech companies to be able to lead and win the AI race.
That is NVIDIA CEO Jensen Huang. Meantime, Bloomberg opinion columnist Chu Li-ren says a new China buys China narrative is taking shape as the U.S.-China tech rivalry heats up. Chu spoke earlier to our TV colleagues Sherry An and Avril Hong on the Asia trade.
So, Shuli, what do we know about this potential for China when it comes to its own homegrown tech?
It's interesting because the AI industry is evolving. No doubt, Nvidia has much better chips, but its chips are very expensive, and they're more suitable for those big, large language model training programs. Nowadays, people are moving into AI applications, and the inference stage, basically telling a pre-trained model to churn out responses to user queries, is becoming a little bit more important. And the chips for those inference stage, for the inference stage, they don't need to be as advanced. They can be a little bit cheaper, and the technological aspects can be a little bit lower. And that's where the Chinese company are seeing an opening. They probably still cannot compete with Nvidia on the training aspect, but on the inference aspect, they can.
Is this why Cambricon is doing as well as it is? It can do things at a much lower price point than Nvidia?
Yes, absolutely. Earlier in the year, one government-affiliated academic research institution said that Cambricon's so-called application-specific integrated circuits, that they are quite compatible with DeepSeek's big training models. And the people think that now that it's clear NVIDIA can ship the H20 chips to China, that the Cambricon can actually come in and take market share away.
But Shuli, China, of course, is known for fostering national champions, but some of those bets end up badly with debt buildup, scandals as well. Is Beijing rethinking its strategy now? What are we expecting?
Absolutely. If you recall, like in July, President Xi Jinping actually said that not every provinces need to have their own AI chip factories. And what you are seeing is that China is trying to rein over investment in chip sector, and also the government doesn't want to spend tens of billions of dollars on those big investments. They want to do venture capital, like early stage investments on chip design companies. And what you see is that in the future, software and design are going to be the focus.
Shuli, great to have your opinion. Chu Li-ren is Bloomberg opinion columnist. And as we've been seeing authorities in China urging local tech firms to use homegrown chips, we've been seeing chip stocks in China also climbing in recent days.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.